So this kind for the attendance, because I already checked that one is about altogether you have 34. I think that is the number that's supposed to join this morning class. Okay, so regarding your class here, we still suppose that you need to form a group, but we're going to wait for the end of this week. Maybe next week, settle with your group members because there is still changes in the list of the names of the in the class. So maybe next week, hopefully that by the end of this day, and then next week should be okay. That we're going to have the fixed numbers and the fixed members of the groups. I mean, for this group G, you are group G now, isn't it? Okay, you are group G, right? Any of you are still there? Okay. So we're going to, last time we already discussed a little bit on your notes. Okay. And then anything, is there any new members in this class? I just want to focus on the assessments only for your syllabus last time. Okay, your assessment, if you are new in this class, maybe because I find that it's a few names that are different from previous list. Okay, so the things that I just want to focus here is only on these course assessments. So for course assessments, you have 50% for your coursework. Okay, mid-sem will be 10%. The date will be on 27th of April. And then this mid-sem will be covered topic 1 and topic 2 only. Okay, it will be covered topic 1 and topic 2. Just want to find my pencil. Okay. So we're going to have here for the mid-sem. Okay, mid-sem here that we're going to have here, we're going to cover only, where's my pen? Okay, we're going to cover here is topic 1 and topic 2 only. Topic 1 and topic 2. Okay, and then you have tutorials here. I'm going to provide you with details on the date. Okay, the dates and for all the submissions of the tutorial. Tutorials here, we're going to cover topic 1, topic 2, topic 3, 4, 5, and 7. So your tutorials here 1 until 5. Okay, 1 until 5 plus 7. So plus 7. So the tutorials date I'm going to mention to you. And then the mini case here, mini case will be covered topic 2, I think a little bit on topic 2. And then also topic 6. Okay, 6 and 8. Okay, so your two main case. And then for the projects here, the first project that you have here is on the share-based payment. Share-based payments here is related with topic 9, which is on the must be the standards, standards, relate with the standard. And then the other ones you have for project 2. The project 1 guideline is ready. I'm going to upload that one maybe by the afternoon after your class here. And then for project 2 is a company valuation. So company valuations here is topic 10, I think. Yeah, either these two, 9 or 10 here. So this one will be prepared in a groups. Okay, so for topic 1, the project one, you need to submit this one on 6th of May. Okay, for this one is for project 1. And then project 2 will be on 24th of June. Means that after your final assessments. Okay, and then you're going to have a final assessment. So final assessment 1 will be on 25th of May. Tuesday at 2 until 6 for hours. This one is tentative. We not yet decide about the hours, but that will be the tentative between 2 until 6. The second one will be final assessment 2 will be same day, Tuesday, but the date will be on 15th of June. Yeah? So final assessment 1, we cover topic 3 and topic 4. And then for final assessment 2, we cover topic 5 until topic 8. Yeah. So details about this one we're going to discuss later. I think this is what we already agreed last time. Yeah. Okay. So for later on, I'm going to upload you with the tutorial 1. Mini case already. Questions is ready there. Mini case tutorial 1 and also project 1. Okay. The rest will be upload later on. Yeah? Okay. So anything that you have regarding your syllabus here? Okay, so this one is only the one that we repeat from last class. Yeah? So for those who are new in this class, so this is you should have a syllabus with you. So I just summarize what is the important thing that you need to know from your syllabus. Yeah? Okay, any questions that you have after this one? Any questions? Any of you have a question on this one? Okay, is it okay? Mid-sem. What is question that we have here? Mid-sem, real test. During mid-semester 4 on the same day as our test 1 for statistics. Okay. So this one you need to deal with your lecturers. Up to this date, we still are going to stick on this date. Okay. So at what time will you have your statistic exam? At what time? Are you there?
Yes.
At what time your statistic exam test? 3 to 4:30. 3 to 4:30. Okay. Have you discussed with your lecturer, I mean your statistic lecturers about this one? Really? Have you discussed this one? Have you mentioned? And then what he or she said? Really? You can use your mic? Because if you
Yes,
write it
doctor.
sometimes. Okay, what the your lecturer said about the statistic exam?
So apparently my lecturer for statistics said that he had confirmed with it superior for
Hmm?
this date. So he asked me to reconfirm with my lecturer again. So I think
Okay.
there's a bit of confusion here. So I want to make things clear with doctors. This
This one is your mid-sem exam, isn't it? Same as your statistic. How many of you enroll for the statistic class that has the same like a problem like we? Is it many of you? Do you know some of your friends here? They're taking F44. Many or not many? Yes. Okay, a few of you. Then we're going to I need to know. We're going to discuss together with the rest of the member in the groups. I mean, the lecturers will teach for four. Then we decide on this one. We're going to inform you for the next class, we and the rest, we and and also the rest. Not many who enroll for the statistic. Who involved with the statistic class? Is it not many? Okay. A few later on we discuss on this one. Maybe next week we're going to finalize about this one. Yeah. I need to ask also from others group, others lecturers who have the same problem like Uis and Ang and also Eng. Okay. Maybe we're going to discuss again for the next class regarding your mid-sem exam. Yeah? Okay. Okay, but you don't have a class in the morning, isn't it? Any of you have class in the morning? If we transfer the times to the morning still on Tuesday, any of you have a class in the morning? No class in the morning. Okay. Okay. I'm going to. Okay, we have a WhatsApp group. I want to know in the WhatsApp group, I want to create that one. How many of you have a class in the morning? And we try to decide later on, on regarding your midsem. Okay, because I also need to discuss with your coordinator about that one, Okay, using your WhatsApp group, we're going to create that one. Okay, but after this, after class, we're going to create that one. Just want to know, an average, how many of you have a uh, statistic exam and also have no class in the morning. Yeah, we're going to look at that. Okay, so settle with your midsem. Okay, check your online this afternoon regarding the materials. I'm going to ask you. I'm going to provide you with the mini case and also the tutorials. Okay, so we just proceed with your notes. Okay, last time we start at what page? Last time, if you still remember, at what page that we stopped last time? 12, already 12, yeah? Okay. 12, 12. Okay, so this is what we had done last class. So just one here. So just stop your video because going to use your data. So just stop this one. Okay, so we're going to look at here again for those who are new in the class. Okay, so this is what you have, a basic group structure. For topic 1, we to have just want to go quickly up to 12, slide 12. Yeah, so we're going to have two types here for group accounts here. Either you have a basic group account and then the other ones you're going to have a complex group structures. Yeah? Okay, group structures, the concept of the group account, we need to know the concept, the principles of combination, why we need to combine here, because we have a parents and subsidiary relationship. From when we combine here, we're going to prepare a consolidated financial statement, and then consolidation is done at the dates of the acquisitions. At the date of acquisition is a date when you obtain the control. Dates of acquisitions here is referred to the date when you obtain controls. Yeah? Okay, obtain controls here when you have a share more than 50%. Yeah? Okay, when you have a share more than 50%. Maybe I need, if you have any question, maybe I miss. Okay, sorry. That's why. The chat box is sometimes is full, but sometimes I miss the one that you have in the chat box. Okay, what you want? Yeah, you want me to record this one. Okay. So you can tell about recorded scene. Actually, why you want to use a recorded one? You can be with me now. You still need to have the recorded one for our revisions. Maybe. Okay, so never mind. Okay, so we're going to record this one. Okay, now we're going to proceed with this one. Just a little briefly go through again this one. So we're going to have either a basic one or a complex one. A complex group structure here is one we have more than one subsidiaries. You are going to have a multiple subsidiary or indirect interest. Okay, multiples here we have a parents. We have subsidiary 1, subsidiary 2, subsidiary 3. That one is a multiple. Indirect here means that parents control subsidiary 1. At the same time, subsidiary 1 control subsidiary 2. Let's say you have here 70%. This one, parents have 80% here. So indirectly, parents going to have a control of 56% in S2. So this one is considered as a indirect interest. By 56 here is a indirect interest. This one is we refer to indirect interest. Even though parents only have a shares in subsidiary 1, but one subsidiary 1 also have a control over subsidiary 2, indirectly parents also have a control over subsidiaries too. Yeah. Okay, and then item number 3 here is a combination, direct and indirect interest. Later on at the structures, you're going to look at how they have here direct and indirect interest. And then the last one we have a cross-holding. Cross-holding is very complicated. I think that for your four, you need to know up to this one, direct, indirect, multiples, and combinations of direct and indirect. Cross-holding is very complicated. See? Okay, so the concept, the thing that we need to know is the concept of business combination. MFRS 10, once you have a combination here, you're going to have a subsidiary. We'll prepare a consolidated financial statement. This one is MFRS 10, and FRS 11 here is related with a joint arrangement. For joint arrangement, we have two types, joint operation and joint venture. And then for 1 to 8 here is related with the associate. Okay, this one, investment in associate. Associates here is when you have a share between 50%, okay, but more than 20%. So this one called as an associate. So for each of these type of subsidiary, joint arrangement, and associate, we have a different accounting treatment. Okay, we have a different accounting treatment for different types of business combinations. Subsidiary, joint arrangement, and also associates. Okay, the first thing we need to know what is a business combination. So business combination is a transaction or event which an acquirer obtain controls over one or more business. They have a control. So we have two parties here. Acquirer is a parent. Acquiree here is a subsidiary. So when you combine parent and subsidiary, it become a group. Combine. So in a group, we have a parents and its subsidiaries. Okay, so the acquirers may obtain control. They can have a control over the acquiree through transferring a cash, incur a liability, but once you incur a liability, this liability should be counted using a present value. You cannot use the amount of liability itself. You need to use the present value amount. Yeah? Okay, and then we have the issuing of interest in equity interest, means that you got a shares. Providing more than one types of consideration means that this one for this year is combination either A plus B or C. Yeah? So we come up with a D, yeah? More than one type. And then the last one, we have a contract. Either we are using contract without any transferring of consideration, but we only provide a contract. Yeah? Okay, standard that we are dealing with or statute that we're dealing with here is the first one. We have a Malaysians Company Act, not bill. Bill is the US term, yeah. Using Malaysians Company Act. So for Malaysians Company Act, we refer to second schedules for the requirement to prepare a consolidated financial statement. And then second schedule for exemption for company that do not want to prepare for a consolidated financial statement. Yeah? Another standard that we are using is the must be standard, which is MFRS 3. Then 12 here is relate with the disclosure. Only on the disclosure, how we're going to disclose the interest in the others entity, either that interest here in terms of subsidiary, joint arrangements, or in terms of associate. The investment in others subsidiary, joint arrangement, or associate. And then the last one we have separate 1 to 7 is relate with a separate financial statements. Okay, later on we have details about separate financial statements. Okay, this is about the standard that we are using. So one you have here is 1 to 7. This is IAS. So when we convert to Malaysian, MFRS is become 1 to 7. So 1 to 7 dealing with preparations of presenting a separate financial statement. And then we have 1 to 8 here. MFRF 1 to 8 here is relate with the investment in associate. So this is standard deal with the accounting for associate. We are using an equity method. So for associate, we're going to use equity method. Then we have IFRS 3 or MFRS 3 dealing with a business combination. Okay, and then how to recognize, how to measure the goodwill. We're going to have a correct goodwill. NCI here is non-controlling interest. For example, here, parents has a share of 80%, so means that another 20% is regarded as a NCI, non-controlling interest, or previously known as a minority interest. Same thing, yeah? Okay. The goodwill calculates here is a difference between the purchase price, how much you paid for the considerations that paid, minus net identifiable assets. Yeah? And then you need to identify all the assets and liability here should be measured at fair value. Yeah? Okay, and then relate with another standards here. If MFRS 10, MFRS 10 here is relate with the preparations of a consolidated financial statement. When a parent has a control over the subsidiary, they need to prepare a consolidated financial statement. Yeah? So in the standard mentions about the procedure and then how they want to recognize the investments. Yeah? And the 11 here is relate with the joint arrangement. For joint arrangement, we have joint venture. And then the other one is joint operation. And then this one, MFRS 12 is relate with the disclosure. So every standard need to comply with. I mean that if you are using 11, then you also need to use 12 here because this 12 here is about the disclosure. How we're going to present your investments here in the segment of in the financial statements. Yeah? Okay, we have done about this one, the separate financial statements. So separate financial statements here, this standard should be applied in accounting for the investment in subsidiary, joint venture, associate when an entity alike or is required by the regulation to prepare a separate financial statement. Okay, this separate financial statement should be prepared according to all applicable MFRS. except for the one that you have in paragraph 10. So this is what it means by paragraph 10. Okay, paragraph 10 mentions that when you prepare a separate financial statement, the investment in the subsidiary, joint venture or associate should be valued either at cost, value of your investment at cost. If that one is related with the financial instruments, it should be used as standard MFRS 9, how to value the financial instrument. And then either you are using the equity method. This equity method is your investment in associate. We need to use the equity methods. So this is about the separate financial statements. Okay, this is examples of financial statements, separate financial statement. So if you look at here, we have two items here. The first one is a group, and then the second one is a company. You have a group and you have a company. So look at the things that you need to focus into this one. So this is what I mean by when you prepare a separate financial statement. Okay, for a parent, so assume that you are parents now, you're going to have two accounts. One is a group account, and then the other one is for a company account. So the company account, if you refer here, for the company accounts, okay, parents going to disclose all the investment that they have. Okay, they disclose all, including the investment in subsidiary. Okay, they disclose all investment. Okay, including the subsidiary. Okay, and then if you look at the groups here, once you look at the groups here, investment of in a subsidiary here will be zero. Why it be zero here? Because in the groups here, parents going to combine with a subsidiary. So we assume that parent and subsidiary become a single entity. So once there is a single entity, means that there is no investment in subsidiary because you already combine that one. So this is mean by separate financial statement. In a separate financial statement, there will be a value of the investment in a subsidiary. But once you come up with a group, in the columns group, because the groups here, under groups here is combinations between parent and subsidiary. So we assume that parent and subsidiary become a single entity. So we need to offset the investment in subsidiary under group section. But under company section, there is still investment in subsidiary. So you understand about this one, yeah? Is it okay with this one? Why the investment in subsidiary in a group becomes zero here? Is it okay? Please be careful with the... I'm not talking alone, isn't it? You're still there? Any of you? Okay, yeah? Okay. So we're going to proceed with the next slide, the one that you have. Okay, so the regulatory here, we're going to use a Company Act. We are referred to the Company Act. So Company Act mentions that once every holding company here is a parent's company, parents need to annex here to produce a consolidated profit or loss account to its profit or loss account and a consolidated balance sheet to its balance sheet. So this one is referred that. Remember that you have a group here and then you have a company. So in the group, we're going to have a consolidated profit or loss. In a company, we're going to have a profit or loss account. This one, for the segments of financial position, you're going to have a consolidated segments of financial position, but for a company, they only have a financial positions. Okay, the difference here is this one, consolidated. So once you have a parents and subsidiary relationship, you need to provide a consolidated financial statement. So this is required by Company Act 2016. Okay, the next one. So this is about the sections in the Company Act. So you have clause 250 relate with the requirement for the consolidated financial statement. 244, you need to apply approved accounting standard. Refer to what MFRS that we are using here is 10 for consolidated. Section 248, present a financial statement in the AGM. Should present this one during the AGM. 247, okay, this one is important, sir. financial year of the subsidiary must coincide with the financial years of the holding company or the parent's company. Yeah? Okay, let's say the parent financial year end is 31st December. The subsidiary also must, yeah, this is a must for the subsidiary to have the same financial year end as a parent. Okay, because why? Because we need to prepare a console. No? We need to console the information between parent and subsidiary. It's a must, yeah? Can coincide with the subsidiary financial year end should same date as the parent's financial year end. Yeah? Okay, so now we are at this station. We are at the consolidation process. So now once you have a controls here, you need to prepare a consolidated financial statement, which is dealing with MFRS 10. Yeah, so this one should get 10 together with 12. Yeah, because 12 here is dealing with the disclosure. So every standard need to deal with 12 also because they are dealing with the disclosure. Okay, if you do not have a controls, means that your share, this one is share more than 50%. Yeah, if the share is less than 50%, is it considered as a joint control? If there is a joint control, it's related to the MFRS 11. So under joint controls here, we have joint operation and joint venture. This part details in part 2. We're going to discuss in part 2 of your note chapter 1. Yeah? Okay, if there is not a joint control, then you have a significant influence. Yeah? Significant influence here. So it's deal with 1 to 8. Yeah? So 1 to 8 here is investment in associate. Or if there is not investment in associate, it can be investment in a financial instrument which is dealing with the MFRS 9. So for 9 here, we need to refer to 7 here. 7 is related with the disclosure specific to a financial instrument. If you look at here, if that one is a subsidiary, if that one is a joint venture, and then if that one is the associates here, we need to deal with MFRS 12 for the disclosure. But for financial instrument, we need to deal with MFRS 7. So this is only the standards that we deal with. Now we're going to focus on MFRS 10 because the other two, joint arrangement and associate, will be in the second parts of your note. So now we are going to start with the consolidation, which is focused on MFRS 10. Okay, so this is what we're going to look at here for the consolidation. It said that a parent should prepare a consolidated financial statement. Okay, and then this parent is defined as an entity that has one or more entity, means that they control one or more entity. And then the subsidiary is defined as entity that is controlled by another entity. Yeah? So this is only the definition. The thing that you need to know here, the parent should present a consolidated financial statements. Yeah? Okay, so we're going to look at the structures. I think that we're going to start with this slide. This one is the one that not yet discussed last class. Okay, so we're going to look at the parent subsidiary relationships here. Okay, the group structure exists when there is a business combination which may result in a parent subsidiary relationship in which the acquirer is a parent and the acquiree is the subsidiaries. So we have two parties here, acquirer and acquiree, or parent and subsidiary. Okay, if you look at the first one, so the first one, when the parents have a control 100% shares in the subsidiary, this subsidiary is considered as a wholly owned subsidiaries of parents. Wholly owned means that 100% shares that are owned by the subsidiary is controlled by parents. Okay, this is another one. This is another situations. Okay, so parents control as subsidiary as here at 80%. So means that another 20% is your non-controlling interest. Okay, and then S is considered as a subsidiary of P because P has more than 50%. So they have a control more than 50%. Okay, and then it said that indirectly, T is also the subsidiary of P through the indirect interest of 56%. Okay, how can it become like this? Okay, you have here parents control S 80%. Okay, and then S. S also control T. Okay, S control T. So T become S subsidiaries. Okay, so T become S subsidiary because S can't have a share more than 70%. So S can control T. So indirectly, P can control T through S. You have an indirect interest. This is what we call indirect interest. And then how we're going to calculate for indirect interest here is 80% control in S time with the S control in T. So indirectly, parents have a share of 56% in T. So this one is a indirect interest. Okay. This one is a very simple wholly owned, but this one is a indirect interest. So this one is considered as a direct. Direct here only P control S. This one is indirectly. Okay, with this one. So we proceed to the next one. Okay, this is related with the stage of piecemeal acquisition. Piecemeal acquisitions here is when the business combination in which one entity they obtain control of another entity, but for which the date of obtaining control does not coincide with the dates of acquiring of the ownership or the interest. So this one is very a little bit complicated, the statements here. So if you look at the examples given here, maybe you understand this one. Okay, let's say on the 1st of January 2004, 2004 here. Okay, let's say A only have 10%. Okay, when they have a 10% means that they do not have a control because this one is only less than 50%. So during this time, we said that there is no parents and subsidiary relationship. No, not yet during this time. No parent and subsidiary relationship. Okay, and then on 1st of January 05, assume that parents bought another 45%. So now the share become, the control become 55%. So 55%, which is more than 50%, during this date, assume that the parent has a control. So they're going to have a control. So this date is known as a acquisition date. So the acquisition date is a date when you have a control over the other's company. So this one we call a stage of piecemeal acquisition. On January 2004, there is no control. This is a just like a normal investment. This one we record as investment only. Okay, a normal investment. But it come to January 2005, you add another 45%, then your shares here become 55%, which is more than 50%. So now we know this one as an investment in subsidiary. Okay, the different. This one is only investment, but this time once you have a shares more than 50%, it's known as a investment in subsidiary. So during this date, you have the control. So this date, the 1st of January 2005 here is considered as a acquisition date. Yeah, this is the acquisition date. So starting from this date, then we start to prepare a consolidated financial statement. Yeah. Okay. So this is an example, so more complex about this one, about the Alibaba groups. Okay, just want to show you the example of complex group structures. Okay, the same thing for this one, vertical group structures for the Prestige Cruise International. Okay, examples only, I just can look at the complex or how very complex for the group structures, but yours is not so complex like this one, only have direct and indirect only. Yeah? Okay, this is another example of direct and indirect interest. Okay, so this is what we have. Okay, another examples. Okay, and then this is a cross-holding. This one is very complicated. The cross-holding between among Samsung Group's company. Yeah, they start with the Lee family, and then they come up with a new company, Samsung Everland. It's very complicated, this one. It's about a cross-holding. See? This one is only the example. So for 4, we only focus on multiple subsidiaries, direct subsidiaries, combinations of direct and indirect only. Not up to this one, not until the cross-holdings. Okay, so you see on the regulatory frameworks here, to the MFRS 10. So in MFRS 10, it mentioned that an investor has a control. Okay, it said that investor control investing when it expose and have a right to variables to return. To variables to returns here means that to change the returns here. Okay, to change the returns, okay, from its involvement with the investee and has ability to affect those returns, okay, through its power over the investee. So what is said that when you have the investor have a power control when they have a power to variables a return and also to affect the returns. Okay, so this is what we have. What means by controls here? Okay, the investor can control the investee if and only if when you have all the following criteria. Okay, the first one, you have the power or the right that give the current ability to direct the relevant activity of the investee. For examples here is in the voting right, potential voting right, contractual, removing right of the key management. So powers here, you have the controls in terms of you can direct the activities of the company. Okay, you involved with the operations of the company. Okay, direct the operations of the company, power to direct the operation. And then the other ones, the first one is to direct the operation. Okay, the second one, you have the right. Have the right to variables the return. To variables the returns here is to change the returns. Yeah? Change the return. Let's say the company said we're going to pay you 10%, but they say no, we're going to receive another 15%. So they can variables the returns. Yeah? Okay, and then the other one, they can use the power over the investee to affect the amount of the return. This one is in terms of the changes in the return, and then this one is about the amount of the return. They also can have affect the amount of the return. They can say about the amount of the returns. Yeah? So this is in terms of the control. So the controls here is relate with the power to direct the operation. The other one, they have ability to variables the returns or to change the returns. Okay, and then the last one, you have the third one here is to affect the amount of returns. Okay, so this is relate with the power. We said that when we have a power, when we have all of these three criteria, we can direct the operations of the company, we can variable or change the returns of the company. Means that the returns here is written how much the company going to pay to the shareholder in terms of return of the investments. Okay, and then also affect the amount of the returns. Return that we refer here is the return on investment. Yeah. Okay, maybe measured using the earning per shares, maybe. Okay. Maybe other method they use to measure the returns on investments. Yeah. Okay, so there is some assumptions for not preparing a consolidated financial statement. We said that when a parents control a subsidiary, it should prepare a consolidated financial statement. But the MFRS 10 in paragraph 4 also mentions that okay, there is assumption not to present the consolidated financial statement if the subsidiary is a wholly owned by a parents or if there is a partially owned subsidiary or by another partially owned subsidiary of another entity and all its others owner, including that those are not otherwise entitled to vote, has been informed about and do not object to the parents not to presenting a consolidated financial statement. Okay, the first situation here, you are wholly owned. Wholly owned means that you have 100%. Parents have 100%. The second situation, partially here means that maybe parents have 90%, another 10% here is owned by NCI. Okay, so both party, parent plus NCI, they are agree not to. Okay, both of them are agree not to prepare consolidated financial statement. Okay, the first situation here, all the parties here agree not to prepare a consolidated financial statement. The second situation here is debt or equity instrument are not traded in a public market, exchange or over the counter. Okay, the second situation here is a not listed company. Okay, you are not a listed company. And then the third situation here, you are not in the process. The company is not in the process of filing the financial statement with the Security Commission and others regulatory organization for the purpose of issuing any class of instrument in the public market. Okay, what's the difference here? Okay, again, the first one, agree. Parents plus NCI agree not to prepare. Not to prepare. Okay, the second one, not listed. Company are not listed, so they are not subject to the standard. Okay, and then the third one, there are no intention. There is no intention to be listed. Okay, and then the fourth one here, ultimate or any intermediate parent produce consolidated financial statement that are available for the public use and comply with the standard. So ultimate parents, okay, parents already produce a consolidated, okay, produce consolidated financial statement. Like this example here, P has a control over S 80%, and then S has a control over T like the one that you have previously 70%. So in this case, P is a parent, S is also a parent to T. So since okay, suppose that S also need to prepare a consolidated financial statement, P also going to prepare a consolidated financial statement. So in this case, okay, since S is a subsidiary to P, and then P also have indirect control over T, so P here is considered as an ultimate parent. So we only need to prepare one consolidated financial statement, only this one. This one, S and T, we don't have to prepare this one. We don't need to prepare a consolidated financial statement because the ultimate parent, who is P here, already prepared a consolidated financial statement. Okay, only P that going to prepare a consolidated financial statement. So S to T, they do not have to prepare the consolidated financial statement because P is their ultimate parents. Okay. Do you understand about this one? The four assumptions given for not preparing the consolidated financial statements. Is it okay with this one? Any of you? Okay, so understand about this one. Yeah. So we proceed. Proceed to the next slide. Okay, for the next slide, here is why we need to consolidate. Okay, so why? Because we want to make the information become useful to the user. Okay, information must be useful to the user in the process of decision making. Yeah. Okay, the second one is assessments of the entity prospect for the future cash flow. Want to assess for the future cash flow. Want to know also about the resources and the assets, liability, and how efficiency here is the profitability of the company. Yeah, so we need to know the combinations of the parents and subsidiary, how they are profitable or not. Okay, how many asset that they have, how many liability that they have. Okay, and then the same another things are important here because we need to comply with the MFRS 10. Yeah, because once you have a parents and subsidiary relationship, you need to prepare a consolidated financial statement, assuming that you are a single entity, which is a combination between parents and subsidiary, become a single entity. Yeah. Okay, another reason here why we need to prepare a consolidated financial statements here because we want to make sure that the information about the economic entity as is relevant for the investor to make a decisions making. Yeah, okay, to predict for the future outcome, which has a predictive value. And then the second one here is the faithful represent, means that all the informations about the economic entity should be disclosed, including the assets and also liability and its profitability. It's related with the qualitative characteristic of the accounting information. So we need to prepare considerations here. The first thing, because of the standard required for that one. Okay, the second one, because we want to help the user for decision making, and also to predict for the cash flow. And then the last one, we want to know about the situations of the company, how much the asset that they have, the liability, and also their profitability. Yeah? So that is the reason why we need to consolidate. So, okay, this one is, yeah, you have here consolidate. See, under why we need to consolidate here, we need to refer to the primary users here. We have investor, lender, and others creditors. So they are going to look at, this user need to know information about the economic entity. Okay, so the economic entity that we have here. So entity A here. So the entity A, they have controls over entity B and entity C. So once they have a controls over entity B and entity C, B and C become its subsidiary, and A here is a parent. So once parent have a subsidiary, they need to prepare a consolidated financial statements. Yeah? So combinations of A, B, and C. Yeah? Okay, at the same time, this entity A also have an investment in entity D, but they do not have a control, means that there is less than 50%. So less than 50%. Okay, this investment also need to be reported in the segments of financial position, but this investment is under normal investment. We just record that one as an investment in D, and then under the category of asset, one of the assets in the A segments of financial position. So we're going to report it as a investment. Okay, that investment is under asset in the segments of financial positions. Okay. Okay, so basic concept for group accounts, we have two concepts here. It's proprietary concept, which is stressed on the ownership interest. Okay, we're going to look at the ownership interest. How many percent of shares that you have, percentage of share, rather than control. So controls here we refer to if you have more than 50%. But for the property concept, we're going to look at how many percent that you have here. If you have 10%, it's considered as an investment. If you have more than 50%, it's considered as your subsidiaries. Yeah? Assume that the shareholders of the parents are the only relevant user, and they are interested solely in the equity shares that they are own. Most of the time, we are going to focus on the parents. Yeah? Focus on the parents as the user, and then they're going to use a proportionate consolidation. Okay, because you only focus on the parents. Okay, and then the other ones, you have entity concept. So the entity concept is stressed on the common control. Common control regardless of the ownership. We're going to focus to the group itself. So group here is combinations. You're going to have a parents, you're going to have subsidiary, maybe you're going to have a NCI also. We're going to focus on the group itself as being a single entity, and that does not make a distinction between different shareholders in the company. The controlling shareholders means that the parents and the NCI here are treated as the shareholders. Okay, let's say the parents have 80%, another 20% here is known as a NCI. Yeah? So both of this one, okay, in a group, okay, going to treat as a shareholders. No, okay, they're going to treat the same as a shareholders. Yeah. So I think that slide 28 is the same as what you have in slide 27. Okay, same, yeah, same as 27. Okay, we're going to skip this one. So it said that in practice, consolidated financial statements are prepared on the basis of combinations of the two concepts. Okay, combination of two concepts mean the proprietary concept plus the entity concept. Yeah. Okay, revenue, expense, assets, and liability of the parent and subsidiary are first aggregated using equity concept. Aggregated here means that we're going to add together parent asset and liabilities are going to add together with a subsidiary assets and liability together with the expense and revenue also. You're going to add this one all together. Aggregate here means that you're going to total up all the amount. Then allocate the result, which is the net profit and the net asset to the NCI. The first step, you need to total up all the assets and liability, expense and revenue between parent and subsidiary. Okay, the second one, the profit here, the profit going to allocate to the NCI. Okay, and also the NCI also entitled for the net asset. Yeah? Net asset also going to be allocated to the NCI. Yeah? Later on, you can look at this one, what it means by the aggregate and then allocate to the NCI. And in the examples, then you're going to look at this one. This is what we need to do. Okay, we need to prepare here the consolidated financial statement, combinations of parent and subsidiary, all the asset, liability, revenue and expense, and parent and subsidiary need to add together. And then after that, we need to account for the NCI. NCI going to share for the profit and also the net asset of the in the companies. Yeah? Okay, the process here. Okay, the first one we're going to look at the process that we have here. So the process here, the first step, you need to combine all the assets, liability and equity income, expense and cash flow of the parent with its subsidiary. Okay, all the items that you have. Parents, asset, liability, equity, revenue or incomes, and then the other ones you have the the expense. Expense for the parents need to total up or add together with a subsidiary asset, liability, equity, revenue, and expense. You need to add together the first one, first step. The second step, you need to eliminate. Eliminate here means that you need to write off because you assume that parent and subsidiary is a single entity. So we need to eliminate the carrying amount of the parent investment in subsidiary. Okay, parent investment, eliminate parent investment in subsidiary. The first thing that the second thing that we need to do, the first one we combine. The second one we need to eliminate parent investment in the subsidiary. Okay, the second thing that we need to eliminate here is the parent portion of equity. Parent portions of equity, portions of equity in subsidiary. So two things that we need to do for elimination for item B. And then for item C, we need to eliminate in full intra-group assets and liability, equity, income, expense, and cash flow relating to the transactions between entities of the group. So the next thing we need to, step one, eliminate intra-group transaction. Okay, inter-group transactions here like this one. Okay, you have a parent and then you're going to have a subsidiary here. Let's say parent sold goods to subsidiary. So this one we call as a intra-group transactions. So once parents sold goods to subsidiary, they can create a profit. Okay, create a profit or maybe they can have a loss here. So this profit or loss need to be eliminated in full. Okay, we need to eliminate the intra-group transaction. Why we need to eliminate the intra-group transactions here? Because this transaction between parent and subsidiary is considered as a, since parent is already a single group, a single entity, so the transactions need to be eliminated. Yeah? Okay, so you need to eliminate info. This one example detail in the second parts of it, not second part, the chapter 2 about the elimination. I think, but in the part 1 of your note at the end, there is an example of the eliminations here. Going to go that one. And the things that you need to know, the process here, the first one, we need to combine all the assets, liability, equity, revenue, and expense between parent and subsidiary. The second one, we need to eliminate the parent investment in subsidiary and also eliminate parent equity in subsidiary. Okay, the third one is eliminate the intra-group transactions. So three things that we need to do. Okay, this is what we have. Okay, if you look at the procedures here, both parents and subsidiary going to prepare their own financial statement. They're going to prepare their own financial statement, a separate financial statement. So for the purpose of consolidation, we're going to combine. So parents financial statement is going to combine with a subsidiary financial statement. They combine. After they combine, they're going to eliminate. The thing that they're going to eliminate here is eliminate investment by parents. Okay, and then the second one that they eliminate here is eliminate the equity portions by parents. Okay, and then the third thing here is to eliminate the intra-group transactions. Intra-group transaction means that transactions between parent and subsidiary. After we have done these three things, then we come up with a consolidated financial statement for groups. Okay, for groups. Okay, this is a procedure that we need to do. So 3 steps: combine, and then eliminate, and also eliminate the intra-group transaction. More details in chapter 2, I think, for the intra-group transactions. Okay, so what the standard said that MFRS 3 para 1 specific that all the, what we have here, all, let's see that one. Acquisitions combinations, whether all business combinations should be accounted by applying the acquisition methods. Okay, so for the consolidation, we are using the acquisition methods. Okay, so what's acquisition methods here? Acquisition methods going to view a business combination from the perspective of the acquirer. So means that we're going to look at the perspective of the parents. It means that the parents going to purchase all the net assets and recognize the asset acquired, and liability and contingent liability assumed, including those not previously recognized by the acquirees. So when they purchase the net assets here is your asset. They purchase the asset, liability. So parent going to purchase net asset. Net asset is asset minus your liability. Net asset. Okay, and also, okay, asset and liability, and also assets or liability which is not previously recognized, not yet recognized. Later on, you understand about this one. Yeah, what is this thing mentions? Okay, and then said that the acquirer record the assets and liability here at fair value. All the assets here and liability here should be recorded at fair value. Fair value, recorded at fair value. Okay, that is what we have. Okay, so using the acquisition method, we assume that acquirer is going to purchase all the net asset. Net asset here is all the asset minus the liability, including those are not yet recognized by the subsidiary. And then all the assets and liability here should be valued at the fair value. Okay, which value that you use here? Fair value at acquisition date. Okay, the fair value at acquisition date. Okay. Okay, so to apply the acquisition method, we have 4 steps here. The first one, we need to determine who is the acquirer. Because we are going to look at the acquisition method, we're going to focus on the parent side. Yeah? So we need to know who is the parents here, who is the acquirer, when is the acquisition date. Okay, acquisition date is date when you obtain controls. Yeah? Obtain controls. Okay, it's considered as the acquisition date. And then recognize and measure the identifiable assets, liability, and any non-controlling interest in the acquiree. Okay, the assets here should be measured at fair value. Okay, and then recognize any goodwill or gain from a bargain purchase. So we need to recognize the goodwill here. So the goodwill here is a difference between purchase price, how much you pay to get that company, and then minus net identifiable asset. Net identifiable asset is asset minus a liability. Yeah? Okay, and then the other ones, okay, you're going to have a goodwill here when your purchase price is more than net identifiable asset, means that you have a positive figures. Yeah, the difference here, you have a positive, then you have a goodwill. But if your purchase price is lower than net identifiable asset, then you're going to have a bargain purchase. Okay, or sometimes we call as a negative goodwill, negative goodwill. But most of the time we are using this word bargain purchase. Okay, this bargain purchase is recorded as an income and then transfer to your income statement. We're going to recognize it immediately, transfer to the income statement. So you understand now we have 4 steps. Need to determine who is the parents. Need to decide when is the acquisition date, the date when you obtain the control. And then the third one, you need to measure all the assets and liability at fair value. And then the last one is recognize the goodwill sales. So for goodwill, you have to be careful, yeah. Okay, the goodwills, you need to know if purchase price is more than the identifiable asset, it become your goodwill. But if the purchase price is lower than the identifiable asset, it become a bargain purchase. So bargain purchase here is considered as an income and they're going to be transferred to your income statements. But this goodwill, once you have a goodwill, this one become your asset. Asset be transferred to your segment of financial positions. Okay, proceed. Okay, so the first one, we need to identify the acquirer or the parents here. And the acquirer is the combining entity that obtain control of the others combining entity or business. Date of acquisition date is date. Okay, acquisition date is date when you obtain the controls. Obtain the control. Generally, the date on which the acquirer legally transfer the consideration means that when you make a consideration or payment, acquire the asset, assume the liability of the acquirer, also known as a closing date. So the date when you make a purchase, make a purchase is considered as a acquisition date, and then make sure that during that time you have a control. Means that when you bought a share here, the share is more than 50%. Okay, the cost of a business combination. So the cost of business combination is stated at fair value at the date of change of any asset given or a liability incurred, and or if there is any equity instrument issue in exchange for the control of the acquirer. Remember that 5 items that you have here: cash, liability, equity, combination, and then contract. Okay, but be careful for a liability should be using a present value because you want to know the value at that time. Okay, so the cost here will be the fair value, should be measured at fair value, any assets given. Okay, and then acquisition related cost to the acquisition is treated as the acquisition cost. So it's include for the acquisition cost include the finder's fees, adversaries, legal accounting variation and other professional fees. Okay, and then this cost going to be recognized as an acquisition expense. So you're going to debit this cost as acquisition expense and then credit cash if there is involved a cash payment or credits payables. Okay, any cost that incurred during the acquisition sale should be recognized as acquisition expense or acquisition cost, debit, and then credit cash or payables. Okay, we'll try to look at this examples. Okay, example 1, ABC acquired 100% interest. So 100% interest here is a wholly owned, wholly owned. Okay, A, just put it A and X. Okay, simple. No need to ABC, so many. So you have 100% here. On 1st of January 2017, the purchase consideration was satisfied as follow. Cash payment. So you have a cash of 1 million. Amount of 2 million to be paid on 1st of January 2019. So this is a liability. Liability, so you need to present value this amount, 2 million present value. The I here is given as 8%, 8%. And then the N here is 2 years. Why this one is 2 years? Because you have here N is 2 because you have 2017 plus 2018 and then going to be paid on 1st of January 2019. So N here will be 2 years. Okay. And then the next one, issue 1 million ABC shares, okay, at the fair value of 4 ringgit. So you need to time with 4. 1 million time with 4 because we need to use a fair value. All this amount should be at fair value. Okay, and then the acquisition cost incurred were directly attributable to the acquisition total of 500, and these have not been paid, mean that there is no cash involved here. Okay, no payments, cash payments. So the things that you need to do here is to prepare or calculate the cost of investment and then prepare the journal entries. Okay, so now we're going to calculate the cost of investment. COI here is cost of investment. Okay, so immediate cash considerations 1 million. So this is already at fair value. Okay, for the liabilities here, you need to calculate for a present value because this 2 millions is the value on 1st of January 2019. Now we want to know the value at, okay, value at 1st of January 2017. Okay, so we need to have a present value. So 2 million, okay, 2 million time with a PV, 8%, and then N here is 2. So you can refer to the table or you can calculate the PV here. 2 millions time with 1 over, okay, 1 plus R. R here is the interest here, 1 plus R, which is 0.08, okay, power by N. You can calculate this one using a calculator. This one is you can refer to the table, either one, yeah. Okay, so you're going to have here for the liabilities here, deferred considerations is 1.715 million, and the fair value of the share issue 4 ringgit time with 1 million unit of shares, so you have 4 million. So altogether, the total cost of investments here will be 6715. So 6715 here is your cost of investment. So the next step, we're going to prepare the journal entry. So the journal entries here, look at the journal entry, you're going to debit your investment in subsidiary. You need to put the word subsidiary because investment, we have a few type of investment. Either that one is subsidiary, joint arrangement, or associate. So you need to be specified here. So this one is considered as a subsidiary here because you control 100%. So you debit investment in subsidiary. Mention if you have more than one subsidiary, you need to mention. So assuming that you have more than one subsidiary, so your subsidiary here WXY, so 6715. Credit cash 1 million that are incurred. Deferred liability at present value. Okay, and then shares capitals here at fair value, the one that you issue a shares here. So this is your journal entry to record the investment in subsidiaries. Okay, the other thing that you have here is acquisition expense. Acquisition that expense that are incurred during the acquisition. So the amount is 500. So debit your acquisition expense and then credit payable or cash. So in this case, we are using a payable because it said that has not been paid. So we are using the payables. We're not using this one. We're not using a cash, but if there is a silent about this one, you can use paper, you can use cash. But in this case, you already mentioned that it has not been paid, so you need to use a payables here. Okay, debit acquisition expense and then credits payables. Okay. We have some more. Okay, so that is what we have. Okay, I think I'm going to start up to this. How many minutes that we have? Yes, still have time. Okay, can we stop up to this one? Or do you have any questions here? Any questions that you have? We go to the example only. Okay, I'm going to proceed. Okay, can we proceed from 2 more slides? Okay, 2 more slides only. Just what we have here before we go to the issue. Okay, it said that consolidations at the acquisition date, when you prepare a group account of a parent immediately, going to prepare the account immediately after it's acquired a subsidiary, means that at the date of acquisition, you need to prepare the consolidated financial statement. At the date of the acquisition, the net asset value of the subsidiary must be stated at a fair value to the parents. You need to state that one at a fair value. Okay, settle all the asset, net asset. Net asset here is asset minus liability, should be stated at fair value to the parents, and then consolidated adjustment are necessary to revise the book value to the fair value. And then you're going to have the pre-acquisition adjustment. So for pre-acquisition adjustments here, parent investment in subsidiary, as stated by the purchase consideration or COI here, is cancelled. It's cancelled and substitute by the underlying fair value of the net asset of the subsidiaries. Okay, remember the step that we have here. The first step, combine. The second step, you need to eliminate. Eliminate, the first one is COI that you need to eliminate. The second one is eliminate the equity. So that, okay, the first, now you're going to eliminate this one. Okay, cancel the COI and substitute the underlying fair value of the net asset of the subsidiaries. Okay, and then so that the net asset for both company are added across and presented in aggregate to avoid double counting in the group account. So another word for the net asset, once net asset is asset minus liability or equals to your equity. Okay, so the next one, the last one that you have here, the last slide before we go for the issue for the next class. Okay, going to look at the consideration procedure. So for consideration procedure, the investments of in subsidiary account, which is COI, cost of investment, is cancelled against the shares capital and pre-acquisition reserve of the subsidiary, leaving the balance as a goodwill on the acquisition. Okay, so cancels here means that you're going to credit your COI. Okay, COI or investment in subsidiary. You're going to debit a shares capital, debit pre-acquisition reserve, and then the difference between these two figures, you're going to have a goodwill. So later on, we're going to look at example to understand about this one. The financial statement of a parent and subsidiary are combined on line by line basis. Means that you're going to combine all the items that you have here by adding together assets, liability, equity, revenue, and expense. So combinations are parent financial statement combined with a subsidiary financial statements. Okay, so this is related with the issues here. Issue, we have a goodwill, revaluation, non-controlling interest, and reserve. So I'm not going to continue with the issue. The thing that we need to know up to slide 40 is only. So for the next class, please read the rest of the slide. Yes, slide 40 until I think that for part 1 you have up to 73, and then if we have time we're going to continue with the second parts of the notes. To summarize this one, the things that you need to know here, okay, regarding the parents and subsidiary relationship, either you're going to have wholly owned or partially owned. Partially owned means that you're going to have the portions of the NCI. Okay, and then the other thing, once you have a control, means that when you have more than 50% control over the subsidiary, we need to prepare a consolidated financial statement. Okay, to prepare a consolidated financial statement here, you need to do the first step, combine all the assets, liability, equity, revenue, and expense between parent and subsidiary. The second step is we need to eliminate the investment using the investments and also the equity portion. And then last one, we need to eliminate the intra-group transaction between parent and subsidiaries. So that is the things that we need to do. Okay, so we have done for this one. This is what you have for the first calculation part. Okay, method that we're using for the consolidated financial statement, we are using the acquisition methods. Acquisition methods here, the first thing that you need to know, who is the parent, because you want to prepare the account based on the perspective of parents. Okay, who is the parent? Acquisitions date, be careful with the stage acquisition, means that you only consider the acquisition date at the date when you have share more than 50%. Acquisition date, and then the third one, what you need to do for the step. Okay, the third one, define the acquisition date. And then after that, you need to calculate the cost of investment. The cost of investments here is combination. Either you have a cash, you have a liability, but remember for liability need to present value that amount. The equity should be at fair value. Combinations of either cash, liability or equity, and then through a contract. And then any cost that incurred during the acquisition is considered as the acquisition expense. So you're going to debit acquisition expense and then credit either cash or payables. So I think that is the end for this today's class. Okay, so for the next class, we're going to look at the consolidations issue. Please read this one because now, up to starting from slide 41, we're going to have a lot of calculations, more calculations. So hopefully that you understand that one. Okay, do you have any questions before we end our class today? Do you have any questions regarding today's class or anything that you want to ask here? Anything? Okay, so no questions. It's okay. So you understand the theory, a basic theory for consolidation. And then the important thing you need to know how to calculate the COI and then do the eliminations. Yeah? Okay, so just stop sharing this one. For those who are not yet scanned for the attendance, or if you have any questions, please. Yeah? Okay, do you still have a question? I'm still be around until 11:30 if you have a question. If no, if you want to left the meeting, you can left the meetings. Yeah. I'll still be around if you have any questions.